Now, we're going to look at some current market conditions. We often, at least twice a year, both myself and Aaron go through the full number of companies on CDAR in Canada. There's over 3,500, almost 4,000 companies on there. And we look through EDGAR in some select areas in the US, looking through companies' MD&As, their annual financial statements. So we're going to give you some of our feedback from our initial search that we're doing right now, the second one in the year. Broadly, in what I'm seeing, and I'll ask Aaron too, is there's not a great deal of value out there. Stock valuations, say to cash flow earnings, are relatively high. If you factor in continual growth, then they may be okay. Then the broader indexes are priced decently, but if you don't factor in this continued growth over the next 2 or 3 years, there's a real argument that there could be a correction. I'm saying that that's going to happen, but when you see broader markets trading at high valuations, this can happen. It can happen in 2 weeks. It can happen in 2 years. But it's when you're not finding a lot of broad value, then it kind of raises some red flags. Number two, we are finding some select value, but particularly in the small caps that I'm looking for, that value is being uncovered more in cyclical stocks, where you have to be wary of value, because if you find a cyclical stock at its peak in terms of earnings, it can fall off a cliff in 1 to 2 years to follow, and then you've kind of had a value trap there. We're also looking at companies. When you see value, there's some red flags around them. I've found a number lately that had good valuations, but they suffer from very poor investor communications, in some cases where management is just really not talking to the market at all. So these companies I would call orphans, and you have to be wary of these situations. There can be some select value found in orphans for the right type of investor, but they're not for every investor for sure. We would prefer to find a company with great value who does communicate well with the market. Sometimes in markets such as this, where you're seeing pricey markets on average, orphan situations stick out because they are not talking to the market. Nobody knows about the situation. And there's a unique situation or dynamic going on in the business. And you have to be wary of these situations as to why they're trading at such low valuations. One other finding that I would say is we are okay right now with holding an above average percentage of cash in our portfolio. It doesn't stress us out to any degree. Why do we have this above average cash value in our portfolio right now? Well, there's, for the small cap coverage that we do in Canada, there's been a number of takeovers just in the first half of this year from companies on our focus buy list. That would include International Road Dynamics, IRD on the TSX, which was bought out. Maris Labs, MSL on the TSX, which is just bought out. And of course, Sandvine, SVC on the TSX, which is just in the process of a takeover bid right now. Part of this has come from also a lack of new buys due to the fact that there's generally not a great deal of value in the market right now. So we'll say that we're patient here and we're happy to wait for good long-term buying opportunities right now.
And of course, what we often hear from investors, especially in a market situation like we're in right now, where we had a great run last year. The market's been pretty flat so far year to date, but we haven't really seen a stiff correction in the market. So of course, investors that we talk to are always concerned, are we facing a correction in the market? And I would say we're probably overdue for one right now, but that's not a prediction. It's impossible to predict. So that's just based on the fact that we've seen volatility essentially, every year since 2010, every year to 18 months, we've seen a fairly stiff correction in the market, after which the market has rebounded and that correction has opened up buying opportunities for us. So I would say that we're probably overdue, but it's impossible to say when that's going to happen. So we're always looking for value. We're always looking for pockets of strength in any market, and generally we're always able to find select opportunities. But as you said, Ryan, you don't have to be in a hurry. If you're sitting on cash right now, be open to buy opportunities, be open to looking at stocks and to adding positions to your portfolio. But we're in the volatile summer period, And as you said, valuations are, they're not extreme, but there's certainly not a lot of obvious value out there. So you have to be very selective, and it's nice to have some capital available in your portfolio to jump on opportunities when they do become available. And we think that there are going to be some good opportunities over the next couple of months.
Yeah, and I'd like to step back and say, it's not an alarming situation or anything that we're not seeing any value out there. We have encountered this numerous times in our sweeps of Cedar and Edgar. Even at the start of this year, really there was a similar type situation where we saw valuations, broadly speaking, relatively high, but we're still able to find some great companies. I mean, I give you an example. At the start of this year, we had a similar feeling going through. We found a company called Photon Control, or we saw it in our research there. It was trading around 85, 90 cents, and now it's $1.40. So a tremendous return since that time. International Road Dynamics was trading then at, I believe, the 230 to 260 range. Broader markets we thought were not cheap, but that company came across our radar and subsequently 2 months later was bought out at over $4.20. So, there is select value that we find. We're just having to dig a lot deeper right now.
Yeah, I think that if you look at just the average multiple right now, it's around 18 right now, which is not out of line with historical averages. I mean, it's not extremely high by any stretch of the imagination, but I really don't think that looking at the average market multiple really provides a good picture of what's going on. So, for example, as you said, there's cyclical companies. There's some decent value there, but that's not necessarily an area that we would advise investors to load up on. And really, you have to take a more granular view of the market and not just look at the averages and just look at what are companies that have growth and strong financial positions and are in generally good shape. What kind of valuations are you seeing on those types of names, and what kind of valuations are you seeing on names that are lower quality? Because you could have a situation where all the good companies are trading at extremely high valuations, and the poor companies with challenges, are trading at extremely low valuations. And if you average all that out, it might look fairly normal. But not saying that that's the case right now. That's just an example of how the average multiple for the whole market, the average valuation multiple, does not necessarily tell the whole picture, tell the whole story.
Yeah, and I think the scenario you painted there, where good companies are trading at higher valuations, and poor companies are cyclical, say the energy sector seem to be trading at lower valuations. I mean, we're closer to that than other scenarios right now, and that's why maybe the average PE doesn't look as high as it should. But you're looking at where you're finding value, like I said, are in some cyclical situations and some special situations where really there should be value right now, because and not necessarily value is the right term, but there should be lower valuations right now in that sector because of the fact that, say energy prices are not where they need to be to have that sector have any growth right now, really. So that's why you see low valuations there. So it's a good reason, and it's a bit of a value trap if you see some there. And we saw that at the start of the year when oil stocks went up initially, but energy prices have not, and oil prices have not had any sustainable run this year. And you see oil prices falling off. And we expect that energy service, and energy stocks could continue to fall off into tax loss selling again this year. Maybe we'll look at the sector at that point, but it's not something we're looking at right now.